I have a strategy tip here for you this morning that I've been researching. You see the market, if you've probably noticed this pattern. Lately, it seems like all the stock indexes do, the E-mini S&P, is if the market gaps up, it just goes up. If the market significantly gaps down, it goes down. It's fighting any notion to fill a gap. There's hardly any gap fills lately. I have a strategy for filling gap fills and just hasn't signaled any trades lately. Gap up, market goes up. Gap down, it almost filled this gap, but it just goes down, then back up, but it doesn't quite fill the gap, and then back down. Taking a look at some more, expand this back. You can take a look, scroll back, look at these other gaps here. You see continuation of the same thing. Some more trades. You see this gap continuation move. Even over here on this is the day when the Twitter report happened. You see the close was right there, and the gap, boom, up. It came back, but it didn't fill the gap. It's fighting gap fills. This day was an exception. This day, it did not fill the gap. When I say the gap, the closing price of the previous day. And so you continue to see this a lot. You know, it's just like the market is opposed to filling any gaps. Here's another gap down, gap up here. Let me draw these so you can see them more clearly. Gap down, gap up, gap down. It just does not fill these gaps. It's kind of, it seems like the market is opposed to filling any gaps, or is going to just run against any gap with the gap in the direction of the gap. So I have a strategy for that. It's good to look at a chart and come up with an idea, but I actually tested this morning, and I want to show you the results of that. So here is the strategy. Here is going back to about February of 2012, so about a year and 3 months. You see today's trade, it's long. Yesterday it was short. What are the results for this? Basically, all this strategy does, you can manually do this. It's 2 lines of code, which is what I have tested here. Looking at the results going back, you see that really nice results. $200 stop loss. So this could be further tweaked probably, but just taking this simple gap continuation approach. If the market gaps up, you buy it on the open. If it gaps down, you short it. And you get out at the close or use a $200 stop loss. And because the stop loss is so tight, you can see this low percentage profitability, but still the average trade profit is there, the drawdown is low, the equity curve is there, and you see this really accelerated in April and so far in May. If you look at the periodical results, last month it made this much on 18 trades. This month it's up 1,000 already. And these are hypothetical. It's just something I'm researching this morning. The market used to be more a gap fill type approach, but now we've got a low volatility gap continuation approach. And so this is with a $200 stop loss. If you back it off and look at a $500 stop loss, I'll show you the results. Here are the results with the $500 stop loss. You get a higher percentage of profitability, but you get less profit and more drawdown. But you see last month you get more profit. So last month that would have helped. And overall, this is not an ongoing thing that works in the market all the time, but it's worked extremely well the last 1 year and 3 months, and it's worked extremely well the 2 days so far into this month and last month. And so a pattern this good is probably not going to continue, but it's something to take a look at and potentially add. What happens if we go back 5 years? I'm going to put this back to the $200 stop loss and go back 5 years. So as you can see, going back 5 years, it's not a great system. Here are the results. You see periods of time when it does really well. It did really well in this time period in 2008, and then did well starting again in February 2012, and it's recently accelerated, and may discontinue after this acceleration. We'll see. It's just such an inefficient, efficient thing, I guess you could say, or inefficient for the pattern to repeat itself over and over again this frequently. You don't normally see that. Variations of patterns. So you can see the long-term results. But if you're looking for a short-term wave, short-term strategy to capture that's working right now, this strategy has been working really well, and you can do it with a $200 stop loss and see how long it continues to last. So That is the update on the gaps. Another thing that the market, I'm making a longer video today. I want to show you the two things that are have been different in the market lately are just this gap continuation no matter what the situation is, and then also the New York Stock Exchange ticks. Here is the NYSE tick. It has ticked above 1,000 going back in April. You see there's the beginning of April. It went above 1,000 only two times uh, going forward from March. It's extremely rare to see the New York Stock Exchange tick below, not tick above 1,000 that rarely, and so the ticks have been compressed, and historically it's much higher. You'd think that just looking at the ticks that we were in a sort of a bearish market because the ticks below 1,000, below minus 1,000, there have been more of those below minus 1,000 than above plus 1,000. So below minus 1,000 is 1, 2, 3, 4, 5, 6 times. Still, that's not very much. Either way, there's not a lot of tick action going on, either in the up or down direction, but it's been down more than it's been up. Yet the market is just marching higher and using gap continuations to do it. So very rare market environment, very unusual. I would anticipate this market environment to not to continue, to not be the new norm, but we will see. So keep an eye on that, and that's what I'm looking at.